Welcome to the Daily Fortune, where we talk about the latest topics about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so you'll know when we upload a new video. Now let's get started. The biggest elephant in the room for the US right now is inflation. With inflation in the United States at 7%, the highest it's been in more than 40 years. One must question what impact this will have on various sectors of the economy, and how will it affect your investments. When describing the Misery Index, Warren Buffett, the Oracle of Omaha, famously stated in his investor letters that a high rate of return means nothing if it's accompanied by a high rate of inflation. As a result, the two end up canceling each other out. When you factor in other investment fees and taxes, you can end up in the negative, resulting in the Misery Index. Inflation is currently about 7% per year and could be one of the biggest degrading factors to your funds. So how do you invest in such a volatile environment, and how do you secure and/or insulate your money? If these concern you, let me provide you with the keys to understanding how to invest during periods of high inflation. Those of you who have been around since the late 1970s and early 1980s can attest to the fact that inflation can be a portfolio killer because it erodes your purchasing power and it hits hard. But for those of you who haven't been paying attention to this, let's go through what causes high inflation and what happens next. Prices for goods and services can vary at any time in the market economy. Some costs increase while others decrease. Inflation happens when the prices of products and services as a whole, rather than just individual items, rise. It means that for $1 now, you may get less than you could yesterday. Inflation is defined as the loss of purchasing power of a currency over time, according to a textbook definition. As the term indicates, persistently excessive inflation is bad for any economy since it erodes money's purchasing value. In order to deal with this, the Federal Reserve manipulates interest rates as a tool for combating inflation. Hiking interest rates diminishes a country's economic activity and as a result lowers inflation as prices fall. Interest rates are likely to rise in an inflationary environment, which will have a negative impact on fixed income assets. At the macro level of global and domestic markets, inflation is one of the risk variables that affect economic cycles and can affect countries if not economies. Now let's look at some methods to invest in a way that provides you an advantage given this background on how high inflation can affect your portfolio. This is very important, so stay tuned. So I've uploaded a video before, and I discussed there what Peter Lynch shared about how to invest during inflationary times.
And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, it's very, I had logics, I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy.
No one can really predict the economy. I believe Peter Lynch explained it better, attempting to predict what the market will do or how interest rates will behave and so forth. On that approach, investing might quickly become a fool's errand. Instead, there are investing steps you can take to help your portfolio not only in these high inflationary periods, but also in times of higher volatility and sudden turning swings. In conclusion, the best strategy to invest during periods of high inflation is to continue to invest in the same way you always have, perhaps with a little more caution. Let's get started with the key points. The first thing I would like to encourage you to do is to assess your investments depending on your investing goals. This may seem obvious, but it's the first thing I would recommend you to do. It's always a good idea to assess your investments and financial goals on a regular basis. But in the current situation, it's more important to do so sooner than later. If you deal with a financial advisor or portfolio manager, ask them to recalculate any goal predictions using a higher inflation rate. In the current economy, most models, for example, including a 3% inflation rate in your estimates, is setting yourself up for a big catastrophe because it's far too low if you plan to retire in the next few years. The first key is significant if you're approaching retirement or want to withdraw some or all of your money from the market in the near future. According to Seth Mulliken, a certified financial planner, CFP, and founder of North Carolina-based Lattice Finance, clients should have a portfolio that can endure some inflation. If that's the case, there's probably not much you need to adjust. But investors who have fixed income portfolios for protection might want to reconsider. Most likely, this will entail making minor changes to the overall asset allocation in order to ensure that returns outpace inflation. Because, as Buffett once said, you don't want to be on the other side of the misery index. Let me tell you, it's a terrible situation. Alright, so moving on to the second key. Don't overact and don't ditch your stocks on impulse. This next bit of advice is for those who are afraid, lighthearted, have paper hands, or can't seem to stop themselves from doing something. Please don't react too quickly. The market is filled with volatility, and high inflation is just one of them. The world won't end tomorrow, contrary to what you may have heard on television. Although expect inflation to remain uncomfortably high for the near future. It's Jerome Powell's responsibility to ensure that even if interest rates are raised, any turbulence in the market will be short-lived in the context of the larger market. Minor portfolio adjustments may be needed, but wholesale changes are almost always a bad idea. Don't let fear cause you to abandon your rational strategy and begin to panic sell. However, if you had a bad investment plan in general, that could be a different story. But I don't believe you do. According to Greg Giardino, a CFP with J.M. Franklin and Company in New York, historically speaking, owning a healthy dose of strong stocks has afforded perhaps the best protection against inflation. Companies are best positioned to respond to inflation, which is why a well-thought-out portfolio is a good idea, especially in high inflationary times. Investing in company stocks makes sense since in most cases, they can pass on cost increases to customers while maintaining profit margins and share prices. At the end of the day, investing in diversified firms through stock mutual funds is a terrific inflation hedge. All you have to do is put your money into trustworthy corporations like Coca-Cola and Apple. Companies with the financial means to raise prices without losing market share. The irony is that both these companies are owned by Berkshire Hathaway's portfolio, and that portfolio is known for being extremely selective when it comes to picking solid firms to invest in. You can't go wrong by following Buffett's advice. Inflation is expected to fall in 2022 as supply chain issues ease up, labor markets recover, and COVID-related emergency cash infusions fade. Most people believe that we're on our way down. The question is, how much lower and how long will it take? By the end of the year, it could be closer to 3 to 4%. A good portfolio will earn you money, whether indeed the forecast proves themselves true or things go in another way, says Peter Lynch. And the third key to remember, carefully weigh bond investments. This is yet another point aimed at individuals who aren't interested in seeing too much red in the market. It's also similar to our first point, which is directed at those who are getting closer to retirement and don't want to lose out on their investments so soon. Bonds help to diversify and balance a portfolio, although their yields are often lower. Most investors regard them as a safe bet, particularly those nearing retirement who don't want to compromise their money, or for persons who are approaching or have reached retirement age and are concerned about inflation. Treasury inflation-protected securities, sometimes known as TIPs or TIPS, according to Giardino, might be a good short-term or immediate-term investment. These bonds are structured such that as inflation rises, the principal value of the bond rises as well. However, because they offer some inflation protection or TIPS, they can be more expensive than your usual bond. As a result, you should carefully examine whether this sort of investment is appropriate for your situation and financial objectives. However, as we consider what investments to make in such an environment, the key is worth remembering. The fourth key is to avoid using cash and instead invest in assets. Cash is the most vulnerable asset class during periods of rising inflation. The value of your cash assets will diminish over time during inflationary situations. Especially in current times, investors tend to hold far more cash than they should, which isn't a good sign. Consider this, at 7% annual inflation, $100 will be worth $93 at the end of the year. Yulin adds that whether you are retired or not, rising prices decrease the value of cash holdings, emphasizing the significance of investing in an appropriately diversified portfolio. To expand our earlier example, he calculates that returning $250,000 in cash would result in a $17,500 loss in purchasing power over the course of a year, assuming a 7% inflation rate. Staying diversified and holding assets that can adjust to changing inflationary situations are still important for investors. Stocks, commodities, and real estate are among these asset classes. You're ready to go once you've made sure that anti-inflation and interest rate buffers like taxable taxable and municipal tips, floating rate bonds, and floating preferred stock ETFs, as well as commodity, oil, financials, industrials, and REIT sectors, account for a significant portion of your portfolio. In all likelihood, this will serve you better than sitting on a large sum of money. Investing in assets that will keep their value during periods of higher inflation is always a good idea. Consumers should examine their income and spending in addition to making investment changes. Making broader financial movements, such as looking for ways to make more money if possible and keeping costs in check, such as substituting cheaper selections at the grocery store and actively shopping for the cheapest pricing, are examples of this. Like the misery index, massive returns are useless if they are wasted.
There's no question that the lack of inflation is a plus for owners. I mean, the real return you will obtain, in my view, from owning American business, if purchased at similar prices, the real return will be higher if we have long periods of low or close to no inflation than if we had long periods of high inflation. I don't think there's any question about that, because that article went on to explain how you got taxed on nominal returns and fictitious returns in real terms. So your question is about which period is better for investors. A low inflation period over any long period is better for investors.
Here's the reality. A low inflation environment is just much preferable to the chaos that accompanies a high inflationary period. Having arrived at this point of high inflation, the steps that I've mentioned in this video, taken from the teachings of great investors, would hopefully assist you in navigating the world of investments. Such economic movements are not to be feared, but rather to be embraced. Thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.